I think the market is getting the sense of this, and certainly for private investors who feel that they might have missed the gold boat, having maybe taken profits at $2,000 or $2,070 when you remember that was the top of the trading range for some time, regretting it and thinking we've got to get back in. But how do you buy gold at $4,130 when you've sold it $100 or $1,000 or $2,000 below the current level? This is a psychological nightmare for investors. So what do? Buy silver. It's far cheaper. That way you get it back in the ride, with a little bit of self-respect.
Financial analyst Alasdair Macleod observes that the gold and silver markets are now entering a critical phase, with mounting evidence that the paper-based trading system underpinning them is beginning to fracture. He points to growing backwardations and unusual market behavior, such as rising prices alongside stagnant or declining open interest, as indicators that short positions are being forced to cover, a classic sign of stress rather than new speculative demand. The situation in both COMEX and London's forward markets suggests a widening disconnect between physical metals and their paper derivatives. According to Alasdair Macleod, this development signals something far deeper than a market correction. It marks the early stage of the fiat currency system's breakdown. Macleod highlights that silver's ongoing surge is the result of long-standing supply deficits that have quietly built up over several years. Industrial and investment demand have consistently exceeded mine production, forcing the market to rely on dwindling investment stockpiles to fill the gap. Today, liquidity in LBMA vaults has become severely constrained, with most silver already tied to major ETFs, such as SLV. In an effort to maintain deliveries, large financial institutions are borrowing silver shares from pension and insurance funds at record premiums, a temporary measure that only deepens the imbalance. Alasdair Macleod compares this situation to a payday loan cycle, a short-term fix that merely postpones a much larger crisis. With more investors seeking physical metal and ETF operators struggling to secure additional supply, he believes the silver squeeze is not near its end, but only in its early stages. Looking forward, Macleod emphasizes that the current gold-to-silver ratio of around 80-1 is unsustainable in an environment where confidence in fiat currencies is deteriorating. As the monetary system loses credibility, gold will resume its historical role as the ultimate form of settlement, while silver will experience an even sharper revaluation due to its dual monetary and industrial demand. He suggests that silver could easily rise beyond $100 per ounce, while gold moves to substantially higher levels as capital flees paper assets. Investors who missed gold's initial breakout are increasingly turning to silver as the more affordable entry point into hard assets. Now, we present the clips from Alasdair's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you and enjoy the video.
Well, I think what you've got to look at is the relationship between speculation and changes in the price. I mean, COMEX is an openly visible market on this one. When you see the price rising and open interest either not following or even contracting, that is a clear sign that the bears are being badly squeezed. And if you look at the level of open interest in gold, it's around about 480,000 contracts, something like that. That's not overbought at all. Yet we've been, as you said earlier, we've been hitting new highs day after day after day. So where's the overbought? It's not overbought. Okay, you look at the RSI indicator. Chartists will say, "Oh, that's overbought," and all the rest of it. But they're looking at the wrong thing. Man does not survive by charting alone. You've actually got to look at the market. So this is a very, very difficult situation for market makers in particular, in futures markets and also in the forward markets in London. I mean, I think in the broader context, what we are seeing is, if you like, the relationship between paper and physical becoming very, very strained. And I think it's a symptom of the end of the fiat currency system. We are beginning to see that the fiat currency system is in huge, huge, great difficulties. Of that, there is no doubt. And fiat currencies don't last forever. They've always got a limited span, and they always collapse, and they always collapse in the same way. They collapse basically because there's just too much debt. The debt just mounts up and mounts up. I mean, the whole point of a fiat currency is you can issue the thing, without constraint. So obviously it gets issued without constraint. So that means there does come a point where the fiat currency can be no more. We've seen, I mean, every collapse of a fiat currency is really from that sort of, from the overloaded debt, the accumulation of debt, and if you like, the dependence of governments on issuing yet more and more currency. Basically, the shortage of silver has built up over a long period of time. I mean, if you look at the Silver Institute's estimates of supply and demand, you can see that it's been supply deficit for the last 5 or 6 years, and it's in supply deficit this year. And the difference is always made up on the Silver Institute's calculations by drawing down on investment stocks, what they call investment stocks. We've come to an end of that. And, the thing that makes it so difficult, I think, is you've got this very limited liquidity. The vast majority of silver in the LBMA vaults is actually for silver ETFs. You look at the big silver ETFs. I mean, basically that accounts for most of it. So the liquidity is actually very, very low, what's actually available. So what we see is authorized participants, as they're known as, the big banks, if you like, who will be listed on SLVs, for example, prospectus. What they can do is they can sell SLV stock for physical. So what they're doing is they're going out and they're borrowing silver, SLV stock, from pension funds, insurance companies, wherever they can get hold of it, and paying a huge, great premium to do it. And actually, it's that there isn't any supply of SLV stock anymore, but they then sell it into the market for bullion and then deliver it, and they're left with a short position. They've got to cover that at some stage in the future. So, this doesn't actually resolve the problem. It just deals with one bank's particular position, short term. It's rather like, payday loans. You run out of money and you've got the bills to pay, and you're not going to get paid until next Thursday or whatever. So what do? You go out to payday lender and you pay 120% or whatever the figure is to, finance your position for 3 days. That's all they're doing. So this is just, storing up continual trouble in the market. I just don't see how this one can really be resolved, because the problem is that all this is going into secure hands. I mean, people are hoarding the stuff effectively. And now, because this is so public, people are subscribing for, guess what? ETFs, silver ETFs, which is reducing. I mean, the silver, the managers of silver ETFs they've got a problem, because they've got to now try and find some silver. And there's very little available in the market. So all these talks about flying silver from New York back to London, I should think most of that silver is spoken for by the ETFs. I mean, when's it going to end, Alex? I just cannot see. This squeeze, I think, has got a long way to go, I must say. I mean, the other thing is that you're looking at a gold to silver ratio of around about, it's just under 80. That is very, very high, particularly if you take the view that we are coming to the end of a fiat currency system. Because the other side of the end of a fiat currency system is the repatriation of gold into its rightful position, which in everyone's common law is final settlement without counterparty risk. It is the true money. And silver has a subsidiary role in that. So we're likely to see the gold-silver ratio fall very substantially. What does that mean? It means the silver price goes up to 100 quite easily. I mean, don't don't hold me to a particular figure, but, for example. And I think the market is getting the sense of this. And certainly for private investors who feel that they might have missed the gold boat, having maybe taken profits at $2,000 or $2,070 when you remember that was the top of the trading range for some time, regretting it and thinking we've got to get back in. But how do you buy gold at $4,130 when you've sold it $100 or $1,000 or $2,000 below the current level? This is a psychological nightmare for investors. So what do? Buy silver. It's far cheaper. That way you get it back in the ride, with a little bit of self-respect preserved. So this silver thing is actually very, very serious and continuing.
Recent signs from the precious metals market point to a deepening structural problem within the gold system, one that's becoming increasingly difficult to hide. The long-standing practice of leasing gold through the Bank of England to maintain liquidity between London and New York is now showing serious strain. Earlier in the year, large volumes of gold were moved out of the bank's vaults, much of it leased metal that may never return. This shift suggests that central banks are quietly retreating from the leasing trade, a foundation that has long supported the global bullion market. Without this flow of leased and released gold, the system loses a key source of hidden supply, exposing vulnerabilities that could spill over into broader market instability. According to Alasdair Macleod, the stress is no longer confined to gold. It's spilling into silver, where the physical shortage has become impossible to disguise. In past decades, bullion banks could quietly patch such gaps, but today's levels of debt, transparency, and global tension make that nearly impossible. Speculators aren't driving the move. Instead, it's a genuine short squeeze, reflecting real scarcity. Yet no one seems able to supply enough physical metal to calm the markets. Even major governments appear constrained. The US has classified silver as a critical mineral, limiting any potential release from reserves, while China has pulled back from exporting both silver and rare earths. The result is a tightening noose on the Western metals market, where the lack of available metal could trigger a broader confidence crisis that authorities can no longer quietly contain.
What we're seeing in the markets at the moment is a squeeze on lack of liquidity. It's very obvious in silver. It's less obvious in gold because you're not getting the high lease rates and backwardations between London and New York. But nonetheless, there is a squeeze in gold because following earlier this year, when masses of gold were taken out of the Bank of England vaults, basically, to arbitrage into New York, a lot of that was leased gold because the principal storers of gold in the Bank of England are other central banks. And the Bank of England has always encouraged other central banks to lease their gold as part of providing liquidity in the London gold market. Now, when you see it actually disappearing out from under the Bank of England's control, you wonder if you're going to get it back. I really do think that central banks as a whole are withdrawing from the gold leasing market. Now, this is very important because it's been leased gold, which has been hypothecated, rehypothecated, rehypothecated to keep the whole system, sort of swimming along. And without that leased gold, we're going to end up with a bit of a crisis. And the other thing which I was sort of thinking this morning, Alex, is that we've had problems in the past in the bullion markets, but they've never been publicly aired, if you like. Only sort of well after the event, you hear that so-and-so had to be rescued or whatever. There was I can't remember that there was a bullion bank way back in Eddie George's days, and I'm going back to, I think, sort of very early 2000s when he had to sort of disappear off from a meeting or from smoking a cigarette outside the Bank of England. Because he was a wonderful trader and a really, really good guy. He had to go and help rescue this problem. This just doesn't happen now. I mean, we just don't see it. But suddenly, yes, we do see it. And it's all over the press. Everybody knows about, that there's a shortage in the physical and the silver market. I mean, they come up with different conclusions as to how to resolve it and what is likely to happen and all the rest of it. But this is a new thing that's become very public, and it must make it very difficult for the authorities to manage a crisis, if you like. I can't see really how this crisis can be easily managed. I mean, in the past, there wasn't, if you like, the sort of current overall level of indebtedness. You had speculators, if you like, driving prices. But if you look at the open interest on COMEX, the speculators are not there. I mean, this is all short squeeze. And how do you remedy a short squeeze? Well, you supply some physical into the market. But who's going to supply the physical into the market? No, not even the authorities have got it. You could argue that the United States might have some concealed silver reserves, but that's just gone on to the critical minerals list, or at least it's been recommended. So it's unlikely that the US government will come to the rescue of London on this one. China, are they going to come to the rescue? I mean, in the past, they have suppressed the price. Of that, there is absolutely no doubt. But it seems to me they've withdrawn from the market. And not only have they withdrawn on silver, but you can see from their policy on rare earths that generally they're withdrawing from supplying needed metals and commodities from the West. So you can see that suddenly, where's it going to come from? And reports that I've had 2 reports in the last few days of enormous demand for silver and gold. I don't know, this is something you could probably comment on, but the dealers in bullion have been absolutely inundated with orders from private clients, from small people, and suddenly, they are just incredibly busy. I mean, I had I was meant to be doing a podcast earlier on this morning, but the people I was doing it with phoned me yesterday and said, look, do you mind awfully if we put it off? Because we're so busy, we just haven't got the time to do it. So this is new. And all this publicity is just driving extra demand. People are just getting in because they haven't got any. So they're trying to get into these bullion markets. So coming back to your question, I mean, there is no doubt that what's going on in the markets at the moment is specific to precious metals, driving up their values. But this is against a longer-term background of what's really happening, and that is it's the values of the paper currencies falling rather than the values of gold and silver rising. Though this squeeze is actually changing that relationship quite a bit.
If current pressures persist, the global metals market could enter a phase of deep disruption as the long-standing balance between paper contracts and physical supply collapses. With confidence in leased reserves and institutional storage weakening, investors may increasingly demand tangible metal rather than synthetic exposure, rapidly depleting remaining stockpiles and driving prices far beyond current levels. Gold and silver would sit at the core of this realignment, gold likely breaking free from its paper-based valuation to reflect true scarcity, while silver faces heightened volatility due to both financial and industrial demand. As the shortage of real metal intensifies, the gap between physical and futures markets could widen dramatically, forcing a revaluation of precious metals as fundamental stores of value rather than speculative assets, and marking a structural shift toward a system grounded in tangible ownership and hard collateral. Could the tightening in physical gold and silver markets signal an impending structural revaluation? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. Thanks for watching.